A new Fed chair is coming to town, and it's critical you know how markets historically react to a leadership change and know what you can do to prepare. The average peak drawdown in the S&P 500 after a new chair starts is significant, about 5% in 1 month, 12% after 3 months, and 16% after 6 months. These numbers can be misleading without the right context. So today, I'm going to break down what the Barclays stat gets right, what it gets wrong, and how a Warsh-led Fed could actually affect your portfolio. Hi, I'm Justin Kuntz, Managing Director of Pacific Wealth Management, and if you're interested in exploring more financial solutions and topics, feel free to look at the resources in the description below. Before we touch the charts, we need to address Wall Street's animal analogies that extend beyond the bull market and the bear market. When discussing Warsh, many analysts have referred to him as either hawkish or dovish. Here's what they mean in more straightforward terms. A hawkish Fed chair means they are more worried about inflation and are willing to keep rates higher for longer even if it slows down the economy. Think of a hawk as a predatory bird. It can attack the economy, slowing things down. A dovish Fed chair means they're more worried about jobs and growth and are willing to cut rates sooner, even if inflation runs a bit warm. Doves are not a predatory animal. They're a lot more cautious, a little more of a skittish bird than a hawk. That's how you can think of those metaphors. For the years following his time as Fed governor, Warsh carried a hawkish reputation. He was known as skeptical of easy money policies like massive bond buying, and he cared a lot about the Fed's credibility around inflation. But in today's environment, his tone has nosedived toward a more dovish form of Warshonomics. The president has made it clear he favors a dovish chair who will support growth, and Warsh has signaled he's on board with that vision. The critical takeaway for your portfolio is this: the market is now pricing in rate cuts to stimulate the economy, but that stimulus could come at the cost of reigniting inflation above the Fed's 2% goal. Back to the Barclays data we talked about earlier. According to Alexander Altman, Barclays Global Head of Equities Tactical Strategies, data since 1930 shows average drawdowns of 5, 12, and 16% over the 1, 3, and 6 month periods respectively after a new Fed chief takes the helm. When looking at the year Powell took office, we can see that the trend took shape once again. As Warsh has hinted in his own interviews, he isn't looking for a standard transition. He's looking for a regime change.
This isn't the first time you've heard me in the last decade say we need regime change at the Fed. It's not just about a person. It's about an approach to economics. It's about approach to what they're doing. And I'm troubled when I see them moving the goalposts.
He has explicitly stated that the Fed needs a new direction, and markets could adjust their Fed assumptions until they get answers to 3 critical questions. What will he do if inflation jumps or unemployment rises? Will he protect the Fed's independence or bend under political pressure? And 3, are we getting tighter financial conditions through interest rate change or through the balance sheet? Until those questions are answered, markets often wobble. That's exactly what the Barclays data is capturing. There are a few holes in the data you need to fill in if you're not careful, however. And here's what the minus 16% drawdown headline can hide. The period since 1930 includes massively different market regimes. The Great Depression, World War eras, the high inflation era of the 1970s, the tech boom, the 2008 financial crisis, and the COVID cycle. So yes, new Fed chairs often arrive near major economic turning points, but that doesn't mean that the Fed chair necessarily caused that drawdown. For example, in 1930, the massive 29% and 43% drawdown when Eugene Meyer took office is right as the Depression era intensified. That's not the result of new chair volatility, but many other market factors. In 1987, Alan Greenspan was sworn in on August 11th. 2 months later, there was Black Monday. The market didn't crash because the new guy got the job title. It crashed because of the market structure and the positioning. The Barclays stat has value, but be careful in reading into it. Those averages hide the real factors driving the drawdowns. Let's get specific about Warsh's actual track record. Warsh served as a Fed governor from 2006 to 2011 and was deeply involved during the financial crisis era. 2 important traits show up consistently in that reporting. Number 1, he's a critic of the Fed balance sheet. Warsh has historically criticized the Fed's bond buying approach and favors shrinking the balance sheet more aggressively than we do today. But something to keep in mind is that the Fed is a committee. Warsh can't just slash the balance sheet on day 1. He has to convince the other 11 voting members to agree with him. So while his instinct is to tighten liquidity, the committee structure could slow him down. A second interesting trait has been his opinions on AI. He's arguing that AI is a deflationary force. His thesis is that an AI productivity boom could justify rate cuts without reigniting inflation. Now, There is some major debate here. A large group of economists have pushed back on that thesis, arguing it's way too speculative. Here's the simple framework. The market will price Warsh into one of three identities. First, he could be the hawk. That means rates stay high and the balance sheet shrinks fast. Tighter conditions and higher yields are bad news for speculative assets. Second, he could be the AI dove. If he cuts rates early, we might get a short-term rally, but if inflation fears spike, long-term bond yields could rise, and that could cancel out the benefit entirely. Third, we get the split signal. He cuts rates, but also tightens the balance sheet. That could create some confusion and volatility, maybe even triggering a drawdown in the market. Be careful with the dove scenario, though. The Financial Times warns that cutting too early based on AI theories could spike long-term borrowing costs. So even a rate cut isn't a guaranteed win if the bond market rebels. Let's take a closer look on what it actually means for your portfolio. When looking at your stocks during a transition, the first move is often a volatility spike. This is the market repricing risk and testing the Fed's new policies. In that environment, you should always be cautious about selling long-term positions just because of a headline statistic. Markets commonly overreact in the short run, and you don't want to get shaken out of a good position by temporary noise. For the bonds in your portfolio, the situation is a bit more tricky. If Warsh is hawkish, long-term rates can stay elevated. But even if he's dovish, cutting rates early, he risks losing credibility on inflation. If that happens, long-term rates can rise anyways because investors demand a higher term premium for the risk. So don't assume that bonds are just an automatic safe haven quite yet. This brings us to the liquidity aspect of your portfolio. During periods of volatility, it's to your advantage to remain liquid. That allows you to jump on opportunities quickly should something pop up. As for real estate and mortgages, if the Fed shrinks the balance sheet aggressively, mortgage spreads and long-term yields can stay sticky. If you're house hunting, you need a plan for rate volatility. Don't assume immediate relief just because there's a new chair in the seat. To avoid guessing what the expected outcomes of policies are, we can arm you with three signals to improve your confidence. The first is if inflation reaccelerates, hawkish policy usually wins. But if the labor market starts cooling and unemployment rises meaningfully, dovish pressure increases. If credit spreads widen and liquidity tightens, the Fed tends to soften their tone, especially if markets seize. Things will likely remain volatile as long as the markets demand clarity around the situation. Eventually, they should re-anchor back down to earnings and settle down. I know that sounds like a lot of different moving parts to keep track of, so if you want us to do it for you, subscribe and check out our other videos along the way as we'll continue to monitor this situation. We'll keep you updated on any significant market changes in the near future. I'm Justin Kuntz, Managing Director of Pacific Wealth Management, and if you found this helpful, click the link in our description below to schedule time to speak with us further, and check out our other videos for more helpful topics about how to improve your financial future.